global recession.
The Swedish economy might be experiencing a stronger recession.
Now officially in a recession.
A warning sign for a coming recession.
The word tends to strike fear into the hearts of pretty much all of us.
What does the worst look like?
It generally means higher unemployment, lower productivity, and less money to go around.
The worst is yet to come.
And from an investment perspective, it can also mean a sea of red across portfolios. But, as the saying goes, out of adversity comes opportunity. And recessions generally bring a lot of adversity. We've dived into the data to check out how different stocks, commodities, and forex have historically performed in previous recessions, as well as providing you with some recession-busting insights. Here at Capital.com, we make explainers on a wide range of financial and macroeconomic topics. Once you've watched this video, check out our recent film on ESG investing. It's a good one. Now, like I said in the interest rates film, I can't tell you for sure what's going to happen, or if there's even going to be a recession. I don't believe in tarot cards, I'm not a time traveler, and I can't see into a crystal ball. But I wouldn't bet against it. We spoke to Steve Clapham, author of The Smart Money Method and founder of the Behind the Balance Sheet Investor Training School, to give us his insights.
The timing will be slightly different. So the UK's gone in faster. UK is probably already in recession. The US is actually coping quite well.
It's very important to understand that every recession is unique. So every asset class performs in different ways in each recession. This type of recession is a combination of 200 milliliters of high inflation and 200 milliliters of high interest rates. Mix it together, and you have yourself a not-so-strong, stagnating recession martini. There's one thing that is often talked about when it comes to investing during a recession: liquidity. Put simply, it's having available funds that could be used to buy stocks or other assets that have dipped in price during the decline, but which the investor believes will bounce back. As Warren Buffett once famously said, be fearful when others are greedy, and greedy when others are fearful.
Having opportunity is enormous benefit in a recession, because in a recession, that's when the people that are leveraged need to get access to cash. They have to sell assets, and that's where opportunities lie.
Right. Let's take a look at our first asset class, stocks. Stocks can be a tough place to be when the economy starts going backwards. They tend to be extremely volatile, and one of the first things to see red when investors panic. Just look at the massive blue chip stock crashes of over 20% in a single day. Amazon and Meta, I'm looking at you. This is because stock markets are forward-looking and price in future expectations, whereas economic data is backward-looking and usually delayed. The key moment traders are looking for is the bottom of the market, which could give them the biggest returns. By the way, check out our recent film, which explores how to spot the bottom of the current bear market. That's a good one too. The bottom, however, is extremely difficult to predict. If it wasn't, well, then this whole investing thing would be easy. Let's look at the S&P 500, a popular stock market index that tracks the performance of the US's 500 biggest companies. Recession hasn't technically hit the US yet, but the S&P 500 has already dropped down around 25% from its January peak, and is currently down around 18% after a recent rally. The median peak to trough drop in the S&P 500 during the last 10 recessions is 24%. However, the median recovery from the trough after 1 year is 39%, and 2 years is 58%. The question then, for investors buying into the index, is whether we've hit that bottom, and if not, whether the index will recover like that this time.
The interesting thing is that if you bought the index in the last 10 years, you did extremely well because the FANGs did really well and were an ever-increasing part of the index.
Yeah, no, not these types of FANGs. He means Facebook, Apple, Amazon, Netflix, and Google. Anyway, back to Steve.
The FANGs are still a big chunk of the index, and they probably aren't going to do as well because they're all starting from, with the exception of Meta and Google, from quite high valuations. And they probably won't, they're very big companies, and they probably won't grow as they did because tech won't grow as it did. And the index won't do as well as a well-constructed portfolio of individual stocks.
Okay, so let's have a look at individual stocks. There's a reason certain individual stocks have historically outperformed the stock market as a whole during recessions. This is because specific sectors tend to weather recessions much better or worse than others. Here are 3 different types of stocks to take note of in a recession: cyclical stocks, anti-cyclical stocks, and dividend stocks. Cyclical stocks are stocks that are extremely correlated to market ups and downs. When times are good, they thrive. When times are bad, not so much thriving. Here's a list of historically cyclical sectors: consumer discretionary, financials, tech, real estate. Now let's look at how they've done in the last year as the stock market sold off. Cyclical stocks have been hammered, with consumer discretionary like autos, hospitality, and luxury goods leading the losses. Real estate has also fallen amidst rapidly rising interest rates and disruptions in the housing market. Tech, which has dominated the news in recent months, has experienced a massive correction after years of seemingly unstoppable growth. Could this be the tech bubble bursting?
The tech boom in the stock market that we've enjoyed so much, I mean, those things are not going to happen again. The FANGs are not going to be where you make your money in the 2020s. The strategy that you should follow now, I think, should be quite different from the strategy that you followed in the 2010s. And I would be more defensive, and I would be much more value oriented.
So what are defensive sectors? They're anti-cyclical sectors that have what's known as inelasticity of demand. That means things that people can't live without. Here's a list of defensive or anti-cyclical sectors that have historically performed well in recessions: consumer staples, healthcare, and utilities. Now let's take a look at how these sectors performed in the same period and compare them. We can clearly see that defensive sectors have fared much better in the economic downturn so far. Consumer staples, utilities, and healthcare are significantly beating the rest of the market. People always need basic necessities like food, medicine, water, and heating. Energy has seen an enormous boost this year, as companies post record profits following the meteoric rise in oil and gas prices. If you don't want to actively pick stocks, there are also sector-specific ETFs. Finally, we have dividend stocks. Investors regularly turn to dividend-yielding stocks in recessionary periods, as they tend to be less volatile than non-dividend stocks. We can see here that in the second half of the 20th century, S&P 500 dividend stocks rarely dropped to more than 10%, whereas the total S&P 500 was much more volatile and dropped significantly below 10% far more often. S&P research also found that the S&P 500 low volatility high dividend ETF outperformed the S&P 500 in down markets 73% of the time, but underperformed in up markets 61% of the time. So again, timing can be crucial. Not all dividend stocks are born equal, too. There are something called dividend aristocrats. I know, you're picturing a stock ticker with a top hat, mustache, and a monocle right now. No? Just me? Anyway, dividend aristocrats are companies that have consistently increased their dividend payments for at least 25 years, meaning they must have strong financials if they survived and still increased dividends during some of the worst recessionary environments in history. In the last few economic downturns, dividend aristocrats have consistently and significantly outperformed the S&P 500. Again, as well as individual dividend aristocrat stocks, there are ETFs that contain a basket of them too. Remember, no matter what stocks you're picking, do your research. Always look at a company's fundamentals, particularly in the economic environment we're in today.
The one thing you must avoid over the next few years is buying companies that are very highly leveraged, because we're in a period in which interest rates are rising and in which the availability of credit may not be as easy as it was in the past. And they therefore may struggle to get the finance, or they may have to pay a very high interest rate. And that's a huge risk. So you've got to avoid leveraged stocks at all costs.
Right. On to our next asset to explore: commodities. Gold has been historically seen as a safe haven asset and a hedge in times of economic uncertainty. It has provided average returns of 14% in the last 7 recessions. It has only lost value in one of them. Some believe interest rates are historically inversely correlated with gold. As rates rise, gold falls, and vice versa.
Well, obviously, rates have gone up, which has been cap and gold's performance. But I've actually been surprised at how poorly it's done, because if you think about what's happening, the invasion of Ukraine, you think about inflation, I would have expected gold to have done better than it has.
The Fed has been clear. There are more rate rises to come, at least throughout 2023.
And we continue to anticipate that ongoing increases will be appropriate.
So if the correlation continues, then gold may drop more. However, when recession hits, interest rates are historically cut to stimulate growth. So if and when that happens, could there be a rally in the price of gold?
I own gold, and I look at it as it's an insurance policy. So, I think it's always sensible to have insurance.
Oil is an extremely important commodity, so spikes in the price of oil have historically preceded or directly caused recessions. In the last 5 recessions, however, the price of oil dropped because as the world economy slowed, global demand fell. Pandemic lockdowns saw industry grind to a halt, and oil prices actually turned negative. Crazy to think now, right?
Well, obviously, if we have a very severe global recession, oil demand will drop. China has been fighting a zero COVID policy. It hasn't been consuming oil, anywhere near its long-term trend growth. So there's quite a bit of slack in the system for that. And obviously, the supply is constrained because companies haven't been investing in creating new sources of supply.
If China, the world's largest commodity importer, rolls back its zero COVID policy, we could see demand increase and prices rise for many commodities across the board, including oil, copper, and steel, as industry restarts, construction begins, and its economy reopens. Finally, we should talk about forex. Currency traders like volatility, and recessions are typically volatile times. The US dollar index, DXY, has gained an average of 8.3% during the last 7 recessions. The Japanese yen has historically fared better than other currencies in recessions. Over the last 6, it's gained an average of 3.5% against the dollar and almost 9% against the British pound. The pound historically acted as a cyclical currency, tied to the global economy, and so performed very poorly during recessions. In the 2008 financial crash, the Japanese yen gained around 30% on the pound. The dollar has been extremely strong throughout this year, hitting record highs, but will that continue?
Well, the dollar's been incredibly strong, and partly that's been down to the fact that the Fed has been early and fast in raising rates. And, that differential is unlikely to be sustained. Is it possible that the US economy stays very strong, they carry on putting up rates, and the dollar stays strong? Of course that's possible. What's the most likely outcome? That the dollar will weaken from here.
Right, we've talked through a number of asset classes. But one more key thing to bring up when investing in a recession, and this is fairly obvious in non-recessionary periods too, diversification, diversification, diversification.
And knowing how to diversify.
The fact is, no one knows for sure what's going to happen in any recession. So you might want to spread your risk by diversifying your holdings across multiple stock sectors, or even different asset classes. I'll leave you with this quote from one of the world's most famous investors, Baron Rothschild. "The time to buy is when there's blood in the streets." He famously made his money in the panic following the Battle of Waterloo against Napoleon, so he would know. Thanks for watching. I hope you got some useful information out of this. Let me know where you will be putting your funds in the comments. Stocks, gold, oil, currencies, let me know. If you enjoyed the video, give it a like, hit that subscribe button for more content, and keep that notification bell switched on.
The interviewees are not connected with Capital.com, and any views that they have are personal to them and are not representative of Capital.com, nor do their views constitute advice.